So, Josh, I mean, do you think that's in part what this is? Maybe easing of the fears that the Fed's going to go too heavy? Because, I mean, Jeremy Siegel was on with me on Overtime the other day. And remember, this is a guy who's been pounding the table on inflation, and the Fed's going to need to do a lot, and maybe even more than the market thinks it's going to do. And now he's done a 180 and says, now maybe the Fed's going to go too hard into a slowing economy, as Anastasia said. Maybe the minutes have made people feel better. I mean, I don't know. What's your read? What's your take the temperature, if you will, of the market right now?
I think we've had enough wealth destruction so that we are finally seeing demand destruction literally all over the economy, and the market is picking up on that. The stagflation people are going to look a little bit ridiculous if they don't let that go. There's really no such thing as long-term stagflation. You could have temporary stagflation, and if geopolitics are involved, that would give you the plausible scenario where we have high prices but a crashing economy. But that sort of thing can never last. And now we're getting confirmation. This morning we learned that demand for gasoline has just hit the lowest level since 2013, ex the pandemic year 2020. That's notable. Why is it notable? Prices at the pump are up 50% year over year. At a certain point, it changes the way people behave, and they stop doing the things they were doing with their cars. We're hitting that right now. We just saw pending home sales fall off a cliff, down 16% in the Northeast from March to April. From a seasonality perspective, that sounds backwards. That doesn't make any sense. Why are they worse in April than March? Very simple. Mortgage rates at 5.25% versus 3.1% in February. That'll do it. So you're starting to see that everywhere, right? You're starting to see the Dollar Generals and the Dollar Trees of the world say, hey, all of a sudden we have all these new customers. I wonder where they came from. We're starting to see Macy's talk about people buying clothing again as though they might actually have to show up for work. These things are what the Fed has been waiting for. The conflict in Russia and Ukraine is what put this off. This would have been happening already. So I think it's been really tough to separate out what's temporary because of China and Russia and lockdowns and wars, and what's the actual inflation story on the ground. And I think the market is sniffing out that the stagflation thing was never really going to be a permanent condition. And so now the question is, can the Fed really turn the U.S. consumer on and off like a video game? Meaning, can we really engineer this soft landing and not have the consumer go full-blown into defensive mode, recession mindset? I don't know. It's never happened before. We'll see. But that's really what the market is trying to figure out now. Because if we're not going to have a recession, but we have prices moderating all over the economy, that's a great setup for S&P 500 components trading at 15 to 20 times earnings. I mean, that works really well for dividend stocks, for REITs, et cetera.
The consumer appears to be holding up fairly well. I mean, I know that there are always instances that you can look at and suggest that it is not, but Williams-Sonoma, Nordstrom, Macy's, right. Well, and maybe we're not ready to write off that story yet. Because if you listen to Williams-Sonoma, Nordstrom, and Macy's, as you said, even if you listen to Brian Cornell, I mean, Target's issues were not related to a slowdown in the consumer. Cornell said that as much on the day of the earnings report when the stock fell out of bed and then hit his head on the floor. You want to say something?
He's got shipping costs. He's got labor costs. Yeah. That's how it is.
So, Josh, I want to take a different spin on your demand destruction. I don't think there's demand destruction.
I can't believe it.
I think there's demand reallocation. And that gets to Scott's point exactly, which is, you know, last week when I was on, I said something about the consumer's really strong still. And there's still a ton of money in consumer pockets, and I got beat up for that. But what we're seeing this week is that's actually true. So you're right. People might be driving less. Maybe they're buying stuff at Dollar General instead of, I don't know, wherever they were buying it before. But people are still spending. And I do not think the Fed does or can turn the consumer on or off. So you're just seeing a reallocation of those dollars. Also, just as a portfolio manager, I don't worry about the Fed that much because I believe that the Fed will be flexible and will act as appropriate and that they'll bob and weave as they go. So I think from an investment perspective, the way to approach this isn't to say, hey, the consumer's falling apart, there's demand destruction, but rather to say, where are their dollars going now? And what we know is their dollars now are going to different places than they've gone to in the past 2 years.
Shepard Smith here. Thanks for watching CNBC on YouTube.